Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the trading week of January 29th through February 2nd, where we'll try to figure out when will the Fed start cutting rates. So thank you again for joining us for part one of our weekly trading game plan for the trading week of January 29th through February 2nd, and let's get started. Welcome, MD, Brian Moritz, Easy Mike. Thank you all for joining us in the live chat today. Hope you all are doing well and had a great trading week. So here's our notes for part one of our weekly trading game plan for the trading week of January 29th through February 2nd. We keep our notes in publicly accessible Google documents. You can find a direct link to this Google document in the description box below. Our notes contain links to bonus videos, to the tools and resources we use to do our market analysis, come up with our trading strategies, trade ideas, etc. We store all of our notes documents in a publicly accessible Google Drive folder, so you can refer back to the notes documents for this week as well as our notes from previous weekly trading game plans. And you can find a direct link to that publicly accessible Google Drive folder also in the description box below. Welcome to Ricky Khan. Thank you for joining us. Hope you're doing well. So first we'll take a look at how the markets ended up on Friday and the main page in FinBiz. We see markets kind of started up, and then, the NASDAQ and S&P eked out a small decline. All the markets had started up, and then again, the Dow held on to a small gain. NASDAQ, S&P had a small decline. We finally saw a rotation out of and profit taking out of what was the Magnificent Seven. Now some are calling the Super Six, with the fall from grace of Tesla. And we'll talk about how we're trading Tesla, probably more so tomorrow. We see even with the decline, we had 52% advancers, 42% decliners. We still had 86% new highs, only 14% new lows. We still got 68% above the 50-day moving average, only 32% below, and 65% above the 200-day moving average, only 34% below. So although the trend throughout the day ended up bearish, overall, most stocks are above their moving averages and pretty bullish. Again, we saw that rotation out of the Mag 7, Super 6, out of technology, and into some other sectors like healthcare. Some of the news. Subsidies for chips. We'll look at the technology components in a minute. All-time highs. So again, all the markets are making all-time highs. So again, a little profit taking at the end of the week is not surprising. Millennials pull out of hedge funds. Saw a surge in oil. You can see oil is now up over 78, so it broke out of that 70 to 75 range due to decrease in inventory, also increased conflict in the Gulf region. Natural gas declined down into the low twos, so we saw it broke down below that 250 and now is in the low twos. Gold still kind of hovering between 2,000 and 2050. And again, right now we see the futures, S&P and NASDAQ negative, Dow slightly positive. The dollar's been, relatively strong. DXY sitting, hovering around 203. And we saw interest rates did surge back up. We've got the 30-year at 4.39, 10-year at 4.16. I think Thursday we had a slight retracement, and then Treasury yields surged back up, and we'll see in the future bond prices declined. Welcome, Ellen Krantz. Thank you for joining us. Hope you're doing well. So now we'll look at this new major index screener that I've got. And also just a reminder, you can also find this screener and the technology component screener that we're looking at in the screeners tab of both of our ETFs and Watchlist Google Sheets. And we'll see our ETFs Google Sheet later. So you can access these screeners at any time. It makes it a little quicker and easier for me to quickly review all of the major indices. So we can see on the daily, the Dow is just, hovering around that upper trend line, just, testing. Got a very narrow channel, so um, I would expect it to continue to consolidate until we get either a breakout or a breakdown. IWM's a little bit weaker, so we can see it kind of rolled over. Might go down and retest that lower trend line. NASDAQ, got a strong breakout in technology, went up to that, broke out of that upper trend line, got rejected, bouncing back down. We'll expect to get some support from that previous trend line and then a pretty narrow range there. Similarly with the SPY, we saw the SPY breakout. It's not now got a pretty steep upward trend. So again, all the major indices made new all-time highs. Again, very bullish. January effect we've been talking about. January tends to be a positive month, and we'll look at how January ended up and what the January barometer tells us in terms of what does that indicate for market performance for the year. Also want to look at the technology components real quickly. Let me grab a drink though first. Okay, so again, we saw this, extremely exuberant rally in technology in general, particularly in the semiconductors. So we see, semiconductors strongly broke out, and then we got the earnings from Intel. The earnings from AMD, very positive, a lot of exuberance, and then it got rejected off that upper trend line. Again, earnings from Intel, their guidance going forward was received pretty negatively, so we saw that very quick decline, gap down in the stock sell and semiconductors. Again, in general, the NASDAQ broke out, finally came back within that channel. Looks like it's rolling over, headed back down to test that lower trend line. And the broad technology, again, we see it tested that upper trend line, got rejected. It looks like, we may have, again, a downward trend with the technology down to those lower trend lines. Biotech was not as strong, didn't really participate as much. Saw some very, short-term chop due to, certain biotechs reporting positive results, but in general, biotech LabU pretty flat. And ARK-K, again, had a negative reaction due to the fall from grace of Tesla, but again, it's not performing nearly as well as some of the other technology sectors. But it does look like it's declining now towards a longer-term moving average, so we might get a bounce off of ARK-K, off that longer-term moving average. So now if we look at the broader groups and sectors, in FinViz, we can go to the Groups tab, see how the sectors performed on Friday. Again, we saw sector rotation out of technology into energy, so back into the defensive sectors, energy, consumer defensive healthcare, whereas the trend, for the week had been very strong technology, strong communication services. Again, we saw oil bounce back up, broke out of 75, headed up towards 80, as we'll see. But again, a defensive rotation on Friday, a lot of profit-taking technology. For January, again, the winners for January were technology, communication services, and healthcare, and the weakest were basic materials, real estate, and utilities. So generally, there's a risk on. Your defensive sectors generally didn't do well. Also, we saw bond yields increase, so your interest rate sensitive, bond sensitive sectors, that was a headwind towards them. So real estate, utilities, etc. Look at the industries. So we saw aluminum got a recovery, coal. So another piece of news that was a positive generally for energy. It was Biden's not approving exports of LNG from the U.S. So that causes an increase in demand for coal, like in Europe, etc. See, oil positive. REITs slightly positive on Friday, some. Big negatives, semiconductors. So again, sector rotation, profit taking out of semiconductors. Again, solar, very sensitive to bond yields, interest rates. So for the week, again, oil and gas. Silver positive, steel positive, copper positive for the week. Again, the big negatives. So some coal, uranium slightly negative, although it's still pretty high. Farm products has been underperforming. Autos, some REITs. So for January, again, the January effect, semiconductors were strong. Insurance, communication services, coal, uranium. The weakest, solar, silver, gold, farm products, etc. So again, going into February, we might see some sector rotation, but again, the interest rate sensitive sectors will depend on when is the Fed going to start cutting. So I'll open up the economic calendar and we'll look at and talk about the economic data we got last week, and then we'll talk about the upcoming economic data, including the Fed's interest rate decision. Just a quick reminder, as soon as this economic data comes out, I try to post it in the Surf the Markets channel in our Discord. So again, a great way to stay up to date with the real-time economic data is to join our Discord. And again, I try to post the data in the Surf the Markets channel in our Discord as quickly as possible, along with any other pertinent news, etc. So again, we'd encourage you to all join and participate in our Discord. And we can continue these conversations, 24/7 there. And our Discord's free to join, and you can find a link to the free invite in the description box below. So I'll just go over my notes quickly, and then we'll go to the overall calendar. So I didn't have much Monday, Tuesday, Wednesday. Thursday, we got building permits. It was positive, although below expectation. We got jobs data. So continuing claims was higher than expectations. Initial claims was also higher than expectations, but not, dramatic. So the job market is slowly weakening, just slightly. And then part of the big data we got was GDP data, was the quarter four, Q on Q, quarter on quarter, was much higher than expected. So no risk of recession anytime soon. So again, the economy's chugged along in quarter four. We also got PCE data. So that's one of the prime factors that the Fed uses as an endpoint data point, and core was pretty much in line. Prices, less, a lower increase than previous. Consumer spending dropped a little bit. GDP price index was still positive, but less than expected. Then on Friday, we also got more PCE data, again, pretty much in line. I think this is notable that this is an inflationary data point, and now the core PCE price index year on year dropped below 3%. So I think the Fed's going to like that in terms of winning their war against inflation. So I think that'll be termed as a positive. No reason for them to really increase rates or cut rates, but we'll look at what the market's saying in terms of probabilities in a few minutes. Personal income steady, and spending in December was up higher than expected. So again, Consumers still spent a lot during December. We'll see if that curtails going into 2024. So we'll go through the investing.com economic calendar, see if there's anything else that I missed. Let me grab a drink a second and I'll zoom this in. Okay, so Monday we got some bond auctions. Look like they're pretty much in line. Manufacturing, again, a little weak. Again, the crude oil stock dropped, significantly more than expected. So again, one of the reasons for the pop up in the oil prices. Mortgage rates went up slightly, again with the 10-year bond yield. Manufacturing, now this S&P Global is above 50, so that's actually a positive for growth. Talked about building permits. We talked about jobless claim data. New home sales, still positive. Less than or better than expected for December. Natural gas storage, you see, went down more than expected, but the price of natural gas still went down. Bond auctions look okay. Talked about core PCE data. Baker Hughes, so we saw a little bit of an uptick in oil rigs. So again, possibly with the increase in oil prices, total rigs went up a little bit. So that's a little bit of a trend reversal with the increasing prices in oil. Looks like they're putting a few more rigs back online, possibly in preparation again for the issues in the Gulf region that are continuing to escalate. So now let's look at the data we get for next week. So not a whole lot on Monday. Typical. Tuesday, we get housing prices, get jolts. So that will be interesting. Is the ratio of open jobs to filled jobs decreasing? Again, that was something that Powell mentioned recently. If that ratio is going down, they'll view that as a positive. Got oil stocks, mortgage rates, Chicago PMI, etc. And then on Wednesday, we get the FOMC statement. So again, we'll get their statement, their interest rate decision at 2 o'clock. Then we'll get Powell coming out at 2:30 and discussing their decision. I think it'll be very important. I don't expect, again, not financial advice. I'm not a financial advisor. Our content is all my opinions and for education and entertainment purposes only. But in my opinion, I think they're not going to cut or raise at this decision. So I don't think there's going to be much of a decision. They'll probably hold pat. So it'll be very interesting to hear his comments on, when do they expect to cut. My opinion, again, I think the market's gotten over its skis and predicting, up to 6 rate cuts in 2024, whereas their previous dot plot showed like three cuts in 2024. And you've heard several of the Fed officials have been trying to walk the market back, that they're not going to be cutting as much or as soon as the market's expecting. But again, we'll look at the probabilities that the market thinks right now. So again, I think it'll be very important to listen to his comments in terms of, how many cuts, when do they expect to cut, what would be the trigger for the cuts, etc. And I'll talk more about that again when we get to the strategy section. got an OPEC meeting, so we'll hear if they reduce their quotas any. On Thursday, also get challenger job cuts, jobless data, so that will be input into the next, Fed interest rate decision. Don't expect much change. ISM, manufacturing, so we'll see if manufacturing continues to weaken. We get natural gas storage. And Friday, we get payroll data, so non-farm payroll. So again, unemployment data. So again, this will be important going forward for the next Fed interest rate decision. Is the job market continuing to weaken, and what's the steepness of the decline in the job market? We haven't really seen, much of a weakening of the job market thus far. Get some factory orders, and we also get Michigan sentiment. So Wednesday, Thursday, Friday are going to be potentially, quite volatile days. Get a lot of data. And if depending on what Powell says, if they have to readjust, bond yields and their probability of future rate cuts, we might see some dramatic reactions in the market. Additionally to all the economic data, we're also in the heart of earnings season, so you can see the whole earnings calendar here in investing.com. We've got the Magnificent Super 6 or Magnificent 7. We've got a number of them reporting, as well as some more semiconductors, high tech. I expect we're going to, get additional exuberance in the technology sector, assuming that these technology companies report positively. I think I'm not sure who all's reporting. I think Netflix already reported. That was very positive. They beat all their numbers. I think Amazon, Apple, Microsoft all report at some point. Here we go. On Tuesday, we've got Microsoft, Alphabet, AMD. So Tuesday is going to be significant volatility in terms of the technology sector. Assume they all meet expectations or beat expectations. We'll get a major rally, major exuberance in the technology sector. If any of them come out and miss, although I don't really expect them to miss, you want to listen to their guidance in terms of how do they see the next quarter and 2024 going forward. And if the guidance is weaker than the market expects, then we might see some very quick profit taking in those areas. So I'll let you all, there's Qualcomm as well, Boeing, ADP. So again, huge week for earnings. So you definitely want to look through the earnings calendar and be aware of who's reporting when, what kind of sympathy plays might that bode in terms of your current portfolio, things you're looking to buy, to trade. We talked about the interest rate decision on Wednesday. You can listen to our video on how we recommend trading earnings, how we trade earnings. So I'd recommend you listen to that video on how to make money trading when earnings matter. Earnings definitely matter. As you can see, if companies miss earnings, or even if they issue weaker guidance, as Intel did, they could be punished severely. So now we'll jump over to the market screen in Webull, take a look at how the market's performed in the market screen in Webull. Let me grab a quick drink and we'll take a look at that. Welcome, Walter Lyons. Thank you for joining us. Hope you're doing well. Just a quick reminder, if you're not already using Webull, you can still get up to 75 fractional shares for opening an account, depositing up to or over 25K. If you're under 25K, you can get 20 free fractional shares of stock, each worth $3,000 to $3,000. As you can see, we use Webull for our market analysis, our due diligence, the majority of our trading. And if you'd use our affiliate link in the description box below, you can get your free fractional shares of stock and also help support our BeachBum trading community, which we greatly appreciate. I'm using the online browser version of Webull. This is the market screen of the online browser version of Webull. So we see in the histogram of advancers and decliners, it's pretty balanced. Again, kind of a tug of war on Friday near the all-time highs, but we did have slightly more advancers than decliners. Again, histogram pretty tight, so not significant variance there. As we've seen for a number of weeks, the typical Friday behavior, inflow, sharp inflow at NYSE, profit taking, outflow towards the end of the day in the NASDAQ. Again, you can see a near-term earnings calendar here in the calendars tab in Webull, so you can keep track of, who's reporting in the very near term, how that might affect your trading. Look at all the industries for the week. So top performers, we've got some government activity, education, semiconductors, a little split, consumer goods, oil and gas. So we saw the oil prices, IT not bad, some media, again, oil and gas, real estate operations, probably some REITs, yeah. Some retail. So again, I think a lot of this is driven by earnings. It's going to be more company specific. Get some that beat. It's positive for the sector. Get some sympathy plays. If they miss, it'll drag on the on that sector, because again, we see quite a bit of distribution among the sectors. So we'll look at the ETFs, market ETFs. So down on the NASDAQ. That's probably down on the Dow probably, but we've got up on the Dow. Up. That's a short on the Dow, two shorts on, or short on the S&P, two shorts on the S&P. Again, short on the NASDAQ. Again, this is all Friday, so again, towards the end of the day, we saw those declines. Down on the VIX, up on the Euro. Industry-wide. Some uranium miners positive. The others look pretty mixed. Financial sector rebounded, had some positivity. Utilities, again, rotation into some of the defensive sectors. Energy again. Again, defensive, some cyclical. Materials, again, uranium, steel. Technology generally negative. Commodities, must be platinum, palladium. We'll see all those again in the futures as well. That must be a REITs. Okay, so let's look at the futures. So we talked about the indices, so we can see the futures all very toppy. Looks like, the NASDAQ rolled over. S&P, again, all very toppy, except for the Russell. Again, the Russell looks pretty flat in consolidation. Risk reward on the Russell looks pretty balanced. Nikkei looks like it rolled over. So it had, had a significant run, and then, Looks like the Nikkei's rolling over. Euro stocks, though, looks pretty strong. DAX looks pretty strong. Again, not a whole lot of volatility. I think the VIX is in the low 13s, actually, and the futures is only showing 14. So thus far, we still haven't gotten much volatility. And even when we get a little bit of a pop, it retraces downward pretty rapidly. We'll see. There are predictions that given the economic data, the earnings, also the election cycles, the global election cycles, that we'll see an increase in volatility this year. But thus far, we haven't seen it. Again, we saw oil broke out of that 75, sitting at 78. Looks like it's headed to 80. I would expect a test of that 80 previous resistance level and possibly a rejection unless we get further curtailment of supply coming out of the Gulf. So if that continues to escalate, then we might see oil, continue to run up above 80 and, then maybe to 85 and possibly even above. Again, natural gas had started to run up and then we had a quick drop off. I guess those are mostly weather related. Again, gold's been, sitting between about 2,000 and 2050. Been pretty flat recently. Silver bounced up off of 22. Looks like it's going to test 23. We'll see if it breaks 23 or rejects and retest 22. Platinum pretty flat, although it did have a pop on Friday. Palladium looked like it was going to start to run back up, and then it rolled over as well. And we'll talk about our trade in palladium tomorrow. Cattle running a little bit. Grains kind of down, corn and wheat, but nothing exciting there right now, in my humble opinion. And again, we see the bonds been kind of choppy, pretty flat. We did see, again, yields go up into the low fours, but prices, have been just generally pretty flat. I would expect that to continue going into the Fed interest rate decision and then to readjust, rebalance based on, again, what Powell says. So again, DXY has been just sitting around 103, just chopping around 103. The Japanese yen did decline. Looks like it may have stabilized at a new support level. Okay, so given all of that, we'll take a look at our ETFs Google Sheet. So if anyone has a index, category, commodity, etc. that you want to look at in our ETFs Google Sheet, you can throw those up in the chat. I'll try to look at those. Let me grab a drink a second and then we'll continue. Just a reminder, if you would like 24/7 access to our ETFs Google Sheet, as well as our dividend payers and our options, puts, ROIC Google Sheets, you can get 24/7 access to all of those by joining our Patreon at the All Access or VIP level. Again, once we identify a potential trend, trading opportunity, we use our ETFs Google Sheet as one way to find ways to trade those opportunities. So I don't really have any changes, additions for this week. So I thought I'd just will scroll through these. If, again, anybody in the chat has something specific you want to look at, you can point those out. We talked about, the opportunities. So LabU is the long in biotech. LabD is the short, so you can see that's potentially an opportunity. Again, you can day trade, short-term trade these pairs for the technology sectors. Cannabis not really doing much. Talked about China stimulus. So they had been, declining. They had circuit breakers in their Chinese markets and down quite a bit, and the Chinese stepped in and they're propping up their market. So we got a little bit of a rebound in markets. So again, you could trade those with yin and yang, K-Web, C-Web, etc. Talked about coal, kind of up. Again, talked about corn being down, but the risk-reward profile is not all exciting. The Bitcoin, the previous futures-based Bitcoin ETFs have pretty much been declining, although we got a little bit of a rebound in the block on Friday. So here's the FANG. So again, pretty high, near their 52-week high. So you can short the FANGs with FANG-D along with FANG-U. See the financial market, but it's not quite at its 52-week high, so you can short financials with FAZ. Talked about gold, long GDXU, short GDXD. I'm going to talk probably more detail tomorrow about some of the comparisons of some of these technology ETFs and why we're choosing specific ones to look at shorting those overly exuberant pops. So there's also the single stock ETFs, and I know some people probably did well with the Tesla one. We'll take a look at the Tesla one, but here's the NVIDIA long, NVIDIA short. Talk about oil, so long gush or UCO, short with drip, SCO. Talked about platinum and palladium. Let's see, it popped up a little bit and then kind of stalled. We'll take a look at REMX tomorrow. If you want to short the overall S&P, SPXS, or SPXU, you can see SPXS is showing better risk-reward profile right now. Talked about SOXL and SOXS. So SOXL long semiconductors, SOXS short, or there's also SSG to short semiconductors. Silver long AGQ, short ZSL. So here's the Tesla. One of the Tesla short ETFs, TSLS or TSLQ. I think Easy Mike was mentioning TSLQ. I think somebody else, the Crow or somebody was talking about TSLS. If you want to play the rebound with some leverage, TSLL. Again, the treasuries, if you want to play the treasuries around the Fed interest rate decision, got a number of ETFs where you can play different durations of treasuries up or down. Uranium, there's that URNG miners that was getting some positivity. Keeping an eye on this utilities. We watched this before. UTSL had been declining, got a little bit of rotation on Friday. Again, we talked volatility is generally low. Wheat's not interesting terribly at this time. And again, the yen kind of declined a bit too. So, okay, so I don't see anything offhand in the chat. Again, if I missed your ticker, you can throw it back up there. I'll try to keep an eye. So let's try to answer our question, when will the Fed start cutting rates? So we'll look at the Fed Rate Monitor tool and the CMA Fed Watch tool to look at the various probability predictions as to what's the Fed going to do in their interest rate decision this week as well as going forward. Just a quick reminder, you can find links to these tools in the notes and also on our homepage under the reference links section. So we have links to tools, resources we frequently use, and you can find links to those tools in the reference links section on our homepage at any time. So again, highly recommend you bookmark our homepage. You can jump there, get access to these tools and resources at any time. Also, we've done several videos on how to use the Fed Rate Monitor tool and how to use the CME Fed Watch tool. So you can listen to those videos in more detail via the direct links in the notes, as well as on our BeachBum Trading YouTube channel. So first we'll look at the Fed Rate Monitor tool. So you can see we've got a countdown clock when the next Fed interest rate decision is, January 31st at 2. We can see what the probability is. So right now the probability is very high that we're going to stay the same at 5.25 to 5.5, just a very 3% chance of a cut. So very low probability, of any change on, this week. And that's, again, what I would propose. No change, no cut, no hike, just a lot of discussion, about being data dependent. So then we go out to March. Again, we're trying to see, when is the Fed going to cut? And you can see the market is currently predicting a 46% chance that they're going to do a 25 basis point cut as early as March. So again, I personally think that's overly optimistic. I don't think they're going to cut that soon. And also several of the Fed officials have come out and said, when they're not going to cut till the second half, possibly as late as the third quarter. Again, on just another opinion of mine, not financial advice. But I think we're definitely not going to get any cuts before the second half. Again, it will be very data dependent, but we also have the election this year, and I think they're not going to want to appear political, so that if it seems like they're going to need to do one or more cuts, I think they're going to justify that, strongly with the data, that it is a data-dependent decision, and they're not going to want to appear political. So if they do see more than one cut, I think they'll cut early, maybe June, July, and then, they don't want to do it right before the election, as that might appear to favor one candidate or the other, whether they cut or don't cut. Again, I think they're going to stress that it's data dependent and do all they can to make it appear that it is data driven and not at all politically motivated. So if we go out to May, we can see 50% chance that they're going to do a quarter cut, 36% chance they're going to do 2 quarter cuts or half cut. Go out to June, and now we've got, 50% chance they'll do 2 cuts, 34% chance they're in 3 cuts. July, high probability that they've done multiple cuts. Very low probability that they stay the same. Low probability of only 1 cut. So again, the market's continuing to be pretty aggressive, and that, they're predicting multiple cuts between, May and July. Now we've got a full point cut, so there's 27% chance that they're going to do a full point cut by September. Again, Fed stop plot, the Fed officials have predicted just 3 cuts, so the market again is being, in my humble opinion, overly aggressive at both the number and the rate of cuts. So again, then we see now we're more than a point cut in November, and by the end of the year, got a pretty good probability, a point or more, so 4 or more cuts by the end of the year. And, I think this is the 5 or 6 cut camp is as high as 13%. and almost minuscule chance that they will not have cut by the end of the year. So you can see again, I think the market's being overly aggressive in both the number of cuts and the probability, the rate of cuts. And I think even this week when Fed President Powell comes out and starts talking, I think there's going to be a significant readjustment in both these probabilities and the rates. I think they're going to move out farther and fewer cuts, and not as soon as currently predicted. So again, we could get a pretty dramatic reaction in the markets. It will be a negative reaction, as the market is estimating more and faster rate cutting than what the Fed officials are saying. So if I use the CME FedWatch tool, again, it's got a clock. We can count down clock, and very similarly, we can see the various predictions for the various meetings pretty quickly in the FedWatch tool. So we can see, very high percent chance of no changes in January. Go up to March. I guess I'll have to zoom this out a little bit. Hopefully it's still legible. So again, 46% chance of one cut. Go out to May. Now we've got 50% chance of one cut, 6% chance of two. Out to June. So now possible two cuts, 34%. Well, to July, now we've got more than two cuts already in July. So again, Fed officials are saying 3 for the year, and the market's already predicting they're going to get 3 by July. September, we start to get into 4. November, now we're down a whole point. And no chance we're at where we're at today. Minimal chance we've only had one cut. Again, by the end of the year, the minimal chance is, 2 cuts or more. The probability is a point or more, so 5 or 6 cuts. So again, I think the market's again over its skis. I don't think we're going to get that many cuts, and I don't think we're going to get them as rapidly as what the market is pricing in. So I think we're going to get negative reactions as the market has to readjust. Bond yields probably go up. Again, market probably do some selling off. Particularly your interest rates sensitive sectors will have a negative reaction. So solar, utilities, etc. So let me know what you think. What do you think? When will the Fed start cutting? We saw what the Fed rate monitor tool says, the FedWatch tool says. What do you think? What are your opinions? Let us know in the comments and our Discord, etc. So I also want to look at and talk about the January barometer and what that says in terms of the market performance for this year. But let me grab a quick drink, and then we'll also look at that. So at the beginning of this month, we took a look at and talked about strategies about how to make money trading in January, and you can review those strategies and our discussions via the bonus link to that video in our notes. We also released some shorts on how the markets typically perform in January, best performing sectors and industries. So again, you can review, see how this January performed relative to those historical predictions. talked a lot about, the January effect. Again, all of these talk about how January is typically a positive month for the market, one of the best months for the market. Typically, historically, the markets go up about 1% in January, and then we'll talk about February as well. So we've also got some where we reviewed, January, February, March. So you can listen to those as well. Again, January tends to be positive, and then February not so much. So again, we might see a sell-off going into early February. We may have started to already see that on Friday with the profit-taking sell-off in some of the mega cap techs. Now I want to look at the January barometer for this year for 2024. You can listen to what is the January barometer, what does the performance of January indicate in terms of the performance of the markets for the year. And again, you can get all the details, the historical basis for the January barometer in our previously released video. I want to see how did our markets perform this January relative to historical predictions. And you can get that information on the performance tab of the major world market indices and investing.com. So we'll jump over there. Look at the performance. So if we look at the U.S. markets, we could see for year to date, so for January year to date, the Dow was up 1%, NASDAQ 2.4, the S&P 2.5, NASDAQ up almost 3%. The only negative was small caps. The Russell was actually down for January. VIX, a little bit of positivity. So again, the January barometer says that based on the performance of January, what can we expect for 2024 for the year? So it bodes positively for the Dow, S&P, and NASDAQ, not so much for the Russell. And typically, the January effect, part of that is a buyback of some of the tax loss harvesting. Typically, your big losers, your laggards, and typically a lot of those are small caps. They didn't get as significant of a January effect as they sometimes do, so that doesn't bode very well for small caps. So again, based on the January barometer, it bodes, pretty positively for 2024. So we'll see how that January barometer predictability pans out this year for 2024. Again, you can also review other global world indices in this tab, major world indices on investing.com. You can even, sort them by level of performance. So if you want to see, year to date, who is looks like Turkey, Japan were the top performers, Budapest. So again, you can see who were the top performers year to date in January across the globe using this major world market indices performance tab in investing.com. So again, I hope that all helps. Welcome, Douglas PC. Thank you for joining us. Hope you're doing well. So again, you can listen to, expected behavior of the markets for the rest of the winter. So again, February tends to be slightly positive, but dramatically less positive than January. So we could again expect some drop off, some profit taking since we've been near all-time highs. Going into February. So definitely, be prepared, stay safe, protect your profits. Tomorrow, we'll also look at dividend-paying stocks, and we'll look at several option strategies, additional ways. Again, if we expect some underperforming February and you want to generate income while we're waiting for the markets to bounce back up in March, then dividend payers and some of these option strategies are additional ways you can generate income while we wait for the markets to rebound. So if I missed your question, I apologize. Please throw your question back up in the chat. or if you have any other ETFs you want us to look at or any other topics you'd like us to discuss for a couple minutes, so we can do that. We'd also love your feedback on how we may improve our weekly trading game plan videos, any of our videos, any of our content, our tools, our Google Sheets, etc., our community, our Discord. What can we do to add more value for all of our BeachBum traders? So we'd love your feedback in the comments below in our Discord. Again, our Discord's free to join. We've got a suggestion box channel in our Discord, so you can give us those suggestions there. Again, also in the comments, and you can also find links to all of our social media profiles in the link section on our homepage. Our homepage is beachbumtrading.com, bum without the U. And again, you can contact us any of those ways, provide us feedback if you have questions, if you have any requests for stocks that you'd like us to look at tomorrow, as we'll be taking all of this data and we will be using it as input to select our top swing trading stocks to watch, stocks in our watch list, stocks in our shopping list, and again, we'll also cover dividend payers and our option strategies for generating income. So we hope this all helps. Again, if there's any topics you'd like or questions or stocks you want us to look at tomorrow, we could do that. So we hope we'll see you back for part 2 of our weekly trading game plan for the trading week of January 29th through February 2nd. Again, same bat time, same bat channel, 10 a.m. Eastern time for part 2 of our weekly trading game plan for January 29th through February 2nd. So we hope that all helps, and have a great day.